Since the beginning of the year, Bell Canada has been down of about 15%. So is it a good time or not to buy this stock at the moment? Today, I'll be doing a full stock analysis on the stock BCE. We will go in detail and make a full analysis on this big Canadian giant companies that is both available on the Canadian and in the US stock market. I'll be checking out, of course, at what is its business model, so how are they making their money and who are their customers. After, I'll check out at what have been their recent earnings to see after what is the fundamental analysis of this company. And at the end, I will share with you what is my personal fair price value of this kind of company with a brand new Google spreadsheet that I've developed to be able to see with a multiple of different methods to see what is the right and the fair value of this kind of company. But first, what is this company? If you're Canadian, you've surely already heard about Bell Canada, which is one of the largest telecommunication company in the entire country. In fact, this company has a massive market capitalization of around $50 billion. And what is really interesting about the telecommunication sector in Canada is that it is a triopoly. A triopoly just means that this sector in Canada is divided between three companies, which are Rogers, TELUS, and obviously Bell. On its side, Bell is one of the pioneers of the telecommunication sector in Canada. It has first seen the days in 1880 and it was named originally after the creator of the cell phone in Canada, which is Alexander Graham Bell. Nowadays, this company has extended from east to west with more than 1,000 different shops all around the country. They obviously offers a bunch of different essential services in the telecommunication sector for all the different Canadians, like some brand new phones, but also some internet and television services. BCE also has a bunch of different subsidiaries and a bunch of different companies that they do hold. For example, they own a bunch of different medias like CTV, Crave, RDS, Nuvo, and TSN. And in total, they have more than 6,000 point of sales all around the Canada, with shops like La Source that sells a bunch of different services and products from Bell. In total, in 2021, they've been able to generate more than $20 million of revenue that are obviously coming from their 27 million customers from all around the Canada that are subscribed to their services and products. All of this despite the slight decrease in the revenue of the local phone sector, because as you see in this branch, you can see that many people are usually switching from the good old phone to the brand new cell phone. But on their side, Bell is still the #1 Canadian companies in the telecom sector in terms of their valuation, but they also have the most customers in Quebec and Ontario with a vast majority of products and services that are offered to them. They also have the fastest and the most awarded 5G network in Canada, but they've still been able in the past couple of years to improve the quality of their 5G network. It is why the Bell network has outperformed by far all the different others wireless carriers in Canada in terms of the coverage and the reliability. Now let's take a look at what have been their most recent earnings for 2022. In terms of their earnings, this company has had some pretty fair earnings for the second quarter of 2022. They have increased their operating revenues of about 3%. Their net earnings on their side have diminished of about 11%. However, their earnings per share have massively diminished of about 13%. But year over year, they've been able to increase their free cash flow of about 7%. In terms of valuation, we can see that its market cap is slightly over $52 billion. And this company has a quite fair PE ratio of about 18, which is lower compared to the average in the industry of the communication service. They also have some great profit and operating margin, as well as some great return on equity of about 13%. And we can see that this company doesn't have a lot of cash compared to its massive debt of around $30 billion. But we can see that the beta of the company, so the risk of the company, isn't really high, only about 0.42. And when you compare the 52-week change of about less than 10% compared to the S&P 500, you can see that it has been able to resist way better compared to the market. But what is the most astonishing about this stock is its dividend yield of close to 6.5% per year, which are obviously some dividends that are paid per quarter to the shareholders. But unfortunately, they have such a high payout ratio of higher than 100%, meaning that it's not necessarily sustainable on the long term, because they are using more than 100% of their net income to pay the dividends to the shareholders. Especially knowing that the total revenue of this company have been staying pretty stable on 3 years, which has been reflected obviously on their net income evolution. And unfortunately, we can see that it has been seen also in their free cash flow that have been diminishing since 3 years. And for the price prediction of this company, as you can see, I'm currently working on a brand new Google spreadsheet that will use a lot of different methods to help me to value a certain company, but I'm still not done with it, so I have plenty of different methods that I'm gonna add to it. But at the moment, I have 3 main methods that I'll be using, with the first one being the Peter Lynch valuation, which is quite simple. Basically, it is the future growth of the earnings per share plus the dividend yield divided by the price to earnings ratio. Because as you might know, the earnings per share multiplied by the price to earnings ratio give you the actual price of the company, and in that case, Peter Lynch has decided to add the dividend yield. The ratio is quite simple. If it is less than 1, it is overvalued, between 1 to 1.5 fair value, close to 2 undervalued, and close to 3 way undervalued. And in that case, with the different indicators, we can see that the result is that this stock is currently overvalued. Now for this method of the dividend discounted model, it is basically to use the past dividend payout and use the average of the growth rate, and you divide it as well by the weighted average cost of capital. But unfortunately, the model doesn't work when the average growth rate of the company is bigger than the weighted average cost of capital. And in that case, as you can see, because the average growth rate of the company is higher compared to the weighted average cost of capital, it means that we cannot use this method because we have a negative intrinsic value. But for my last method, the discounted cash flow model, it is a little bit harder, but basically we are using the free cash flow of the company to value what is the current intrinsic value of this stock. And so what is pretty hard with this method is to find the weighted average cost of capital, but I have decided to build a certain spreadsheet that I just have to find a certain number of criterias, and I'll be able at the end to automatically calculate what is the weighted average cost of capital. But as you can see, the current intrinsic value of this company is about $35 per share, when the current price of this company is about $56 per share, meaning that obviously this would be a sell and this stock would be overvalued on that side as well. In conclusion, despite the project value of this company that is potentially overvalued, I personally love this company, and I think that it's one of the great picks that you could be taking a look at in the telecom sector in Canada, because of course it is one of the best blue chip that you can find on the TSX market by giving a massive more than 5% of dividend to their shareholders. But we can also see that despite all the negative news that we've seen on the market, this company compared to, for example, the S&P 500 has been able to outperform the market since the beginning of the year, because of course it is offering some essential services to the different customers that they have, but they are also continuing to work and to improve their 5G network, which is one of the most important characteristics in my opinion for this kind of company. However, if you're someone that prefers to invest in ETFs to reduce the risk of your portfolio by achieving some potential great return, well, check out the video that's going to be right over here that will share with you what are the best Canadian ETFs that you can buy right now in your TFSA to maximize your gain. And for everyone that is new, make sure to join the NO family by subscribing to the channel for only $0.0, and I will see you soon. Peace!